So probably the third asset class that's most popular, and for good reason, with investors is real estate. It's going to be right after your public equity strategies and, of course, your traditional fixed income strategies. Real estate has really been a solid performing asset class throughout history that, number one, acts as a fantastic hedge against inflation. Number two, has actually grown in value slightly more than the S&P 500 when you factor in inflation. And three, it's a great way to generate very tax-friendly income because of the way that real estate, whether you buy it as an individual property or you buy it within a fund, the way those assets can be depreciated. And another reason is that a lot of investors just like to have their money into something that they can see, they can look at, they can touch, they can feel. It's a real asset right in front of you. So in the market environment that we're in today, where we could potentially have a soft landing, we could potentially not, but what we do know is that the terminal Fed rate is going to be over 5% in the next couple months here. So we're in an environment of rising interest rates, which means that anyone who was hoping to purchase a new residential home just had their buying power significantly diminished. So rising rates, not good for residential property. But if you look at other types of real estate that's available in the investment world, talking about multifamily residential and industrial space, there's definitely some good arguments to be made that that still is a sound investment and may outperform over the next couple years. So talking about multifamily residential, considering a period of raising rates, you have a lot of folks out there who are currently renting, have been planning to buy a home. Now with the increase in rates, also with the potential that a lot of folks think that these high rates are temporary, they're going to wait, right? They're not going to do anything. They're going to stay in their rental property and put off that home purchase for a couple years down the road. Also in rental properties, the return or the increase in rents that the investor is going to get generally lags the Fed rate by about 9 or 10 months. So we see the Fed raise rates, and then we see that affect the multifamily residential real estate markets. The second one is, of course, industrial, talking about those large warehouses that cater to the e-commerce companies, which in 2020, e-commerce sales in the US were over 10 trillion. And by 2027, that number is expected to be over 27 trillion. So those are two attractive segments of the real estate market. So how to do it? Well, there's really four main ways. You could just go out and you could buy an apartment complex. You could invest in a private real estate fund where they're holding real estate, generating the rent off of that, and of course hoping that based on their geographical selection, demographical selection, the value of that real estate is going to rise. The other one is, of course, publicly traded REITs, where you're subject to market volatility, which at times they make sense, at times they don't. But one of the most attractive ways right now is real estate syndication, which is really a quite simple structure where investors are pooling their money together to buy one specific, usually multifamily property. So you'd have the syndicator, the multifamily property LLC, that is on the screen right now, and then you have your general partners. So they're managing the investment, they're managing the purchase, managing the process of adding value, which is really what sets a syndication apart as well. They're targeting a property because they believe that they're buying it at the right price, it's in the right area with the right potential that they can then do a value add, talking about remodeling the property, renovating the property, increase rents with the goal to sell it and create a capital gain on the back end, usually in a somewhere between a 3 to 5 year time frame. So you're just an investor or the limited partner, so your role is to really do your due diligence on the particular syndicator that you're working with and collect your returns. And when the investment is sold, hopefully you get a capital gain, and then you find another syndication or another investment depending on where we are at that time. So here's some examples of some recent syndications done by Cadre, which is one of the largest syndicators in the US. You can see you're mostly going to see multifamily residential properties, apartment complexes. One of the nice things about a syndication is you're generally going to see a higher targeted and higher realized rate of return than a private real estate fund, for example. That's because they're doing that value add process. So not only are they raising the rents or income that the investor will generate, but they're creating the growth in the property, actively creating it, where like a private real estate fund is really just a holding company. They're not actively doing anything to add value. The big negative on a syndication is your liquidity. Right here, this is Pilot and Park. It's a property in Savannah, Georgia, by Cadre, and this is expected to be a 4 or 5 year hold. And certainly unlike a publicly traded REIT, also unlike a private REIT, you really have no liquidity until that property is sold. But you can see this is an example. The target IRR is 16.4. Doesn't mean the investor will get that. You could get 17 or 18. You could get 13 or 14. But based on the due diligence that goes into the PPM, which every syndication that you look at should come with a very in-depth, about 100-page PPM that's going to give you all the information and really plead the case on why this investment makes sense. So I mentioned the two categories that may be attractive right now, industrial and multifamily. So this is just going back to 2021, where multifamily returned about 7%. Of course, this was right after COVID. Hospitality and retail were down, but look at industrial, 23%, by far outperforming every other sector of the real estate market. So there are syndications available like this one that, instead of being multifamily residential, are focused on these types of properties that are basically warehouses that are occupied by those e-commerce companies that are expected to see so much growth from the consumer just over the next 5 years. So this is an example of one, Alpine Industrial Park, also from Cadre, target IR 14.7. Of course, could be better, could be worse. So that's a quick overview of how real estate syndications work. If you'd like to take a look at the currently available syndications, certainly reach out to us, and I hope this was helpful to you. Thanks, everyone.